Every business and profession has its unique terminology, its secret handshakes, if you will. And real estate investing is certainly no exception. I frequently see investors, and they're not always beginners, who misuse that terminology. They can not only end up making misguided and costly mistakes, but it's like wearing a sign that says, "I'm just a beginner, please take advantage of me." Learn what the terms really mean and how to use them. I discuss that vocabulary in my course on real estate investment analysis, and I invite you now to watch a brief excerpt from one of my lessons. Okay, the first of these terms is gross scheduled income. And that's the total annual rent value of all units in the property. This amount includes the actual rents generated by occupied units as well as the potential rent from vacant units. Essentially, this is the top line on your P&L, on your APOT. And by the way, this has, as several terms in real estate do, this has an alternative name. It's also called potential gross income. Okay, so that's our top line. The next item is vacancy allowance, which is also called sometimes vacancy and credit loss. Now, this is usually expressed as a percentage of the gross scheduled income. And as its name suggests, it's an estimate of the amount of potential income that will be lost due to vacancy. Credit loss, by the way, is when the unit is in fact occupied, but the check is no good. There's a loss there due not to the lack of occupancy, but the lack of good funds. So some investors do indeed prefer to call this category vacancy and credit loss allowance, so that it accounts potentially for the uncollectible rent as well as the missing rent from vacant units. The third item is simply the difference between the first two, and this is called gross operating income. That's the gross scheduled income less the vacancy allowance. And this one has a second name as well. It's also very often called effective gross income, or EGI. In my experience, appraisers tend to prefer the term effective gross income. Most investors tend to prefer the term gross operating income. But both terms can be used interchangeably. They mean exactly the same thing. And the short version is that this is the amount you actually collect. So this is the total potential income from the property minus what you've lost from vacancy and credit. What's left over is the actual money that comes in, which is the gross operating income.